Allow me now to introduce our next speaker. Shri Jayesh Mehta is the India Managing Director and Treasurer at Bank of America. His views are sought by prominent media channels after most policy announcements in the financial sector. Shri Jayesh Mehta has previously held the primary dealership arm of DSP as well as the fixed income department of Bank of America Merrill Lynch. He will be expounding on the concept of the Public Debt Management Agency as a new merchant banker for the government. Ladies and gentlemen, Shri Jayesh Mehta.
Thanks, Tarun, for making my path a little bit easier in terms of giving the background as to whether PDMA is the right path or not the right path, or whether we need to really move it in a hurry. But just to add to a little background, originally the PDMA part was first time was ever brought out was an RBI annual report way back in late 90s, early 2000. And the various reasons we could not implement that, and now that RBI is going and moving towards single mandate of inflation targeting, and the budget did announce about PDMA. But yes, we do need to have glide path to that, and therefore all I'm going to list down is as all the economists here, everybody has been debating about what the right methodology. I'm just a practitioner and trader of the bond, so I'll just talk about what are the right things before the new platform, if it is to be created. There are a lot of preconditions required from the chain, and whenever we have a change. I think first and foremost, I'll just list down some of it, and I would like to also address a little bit on the bond market, which always get criticized. A lot of my colleagues did criticize it here. So I think first and foremost is the new institutions should have autonomy and credibility. Today, RBI has earned, it's an old institution, they completed 80 years, they have earned the credibility, and they have the autonomy. That's the perception, that they have the autonomy, and they have been quite vocal about it. I think the new institution will have to take some time. You will have to have the right credible people at that institution. You will have to build it, you will have to earn it, so there will be a transition time. The second most important part is the primary dealers, because all government bond auction requires primary dealers as a market maker or underwriter of the bond. As I said, the credibility issue is over the period of time, 98, 96, the primary dealers started. 98 was the first time private sector was allowed in primary dealers. Till that point of time, till now, RBI has maintained a pretty good or earned a pretty good relationship from primary dealers. So in terms of underwriting, you will be surprised the way the primary dealers underwrite in a normal market is less than half a paisa, not even putting the price. They just leave the price open, and they're so much of confident that they will not be get underwritten or devolved on that at off-market rates, and therefore, at a very low cost has been able to do the underwriting. The new institution will have to actually earn that feedback and respect, and maybe a different mechanism in the initial phase on the underwriting, which will be a dual underwriting. So that's one of the things which need to sort. All I'm trying to list down is some sequencing and timing, what we need to do it. Third is, most important thing is FRBM. When a lot of things were thought, along with Ajay, I was also involved in some of them. The initial idea was we were supposed to achieve our FRBM target in 2009. Somehow, due to Lehman crisis, and then the government kind of changed the borrowing and ramped up the borrowing in 2009, and now we were supposed to achieve that by 2016. It's deferred by one more year to 2017. So that's when we achieve our FRBM target. And one of the more core reason the government is able to place the debt at a reasonable price is the SLR. And as of right now, we have 21.5% SLR. And to reduce that SLR in absence of a pretty deep bond market, and yet the government to borrow, it's going to be very difficult. Of course, I'll put some points on the bond market at the end of the some of the sequencing I'm trying to put. I think I also have some questions, not only sequencing. Again, policy rates and liquidity, that will be the prerogative of Reserve Bank, and PDMA will have to really, really coordinate well with Reserve Bank, because at the end of the day, if Reserve Bank is managing inflation, the policy rates would be with them, but then the policy rate and liquidity should be in sync. Otherwise, the policy rate changes will not have really much impact to that. Also, PDMA would be, RBI is today, as of today, one of the largest single buyer of government bonds. Almost 15% of government issuance is with Reserve Bank of India, as compared to, people talk about banks. Banks at the entire industry is 33%. Insurance at the entire industry is 20%. But this is one single buyer, which holds 15% of total outstanding. And this investor also is the only investor who has discretion to buy local assets as well as foreign assets. So, for any debt manager to plan out, he needs to know what is the investor appetite and feedback. So that's going to be very, very crucial. Again, the question is, yes, there has been always debate whether market can find its own pricing, or you always need some sort of support or some sort of guidance. At least I personally feel that, and that's been vindicated over and again time, that yes, market can find its own pricing in a normal market, but in an extreme situation, market do need support. And that's happened in 9/11 time, that's happened in the Lehman crisis, even in US. And that's for financial market stability. Who manages that financial market stability? So that's going to be another question. We need to resolve that. State government borrowing, again, whether they will be giving it to central agency, PDMA might be a central agency, or PDMA would be an independent agency like SEBI, and therefore state government feels comfortable. Another issue on state government is, as of today, people consider state government debt as RBI risk, because the payment and settler of the coupon and interest on state government is actually done by RBI, and RBI has authority and power to put a state into overdraft account. So that's again a question which we need to really answer it before we really we need to sequence that. And I think, there are various points we need to really sequence, but maybe I'm just going back to the bond market as to why the bond market we feel is not developed or anything. And we always feel very proud about our capital market equity side. Yes, it's a great thing, great platform. We have done great on the equity side. The platforms are great. The systems are very robust. In fact, for the bond market also, when Ashish said there was a crisis and there was a reform done, NSE initially was started as a debt exchange. The very first platform, the very first trade which happened ever in NSE was a debt transaction. There are reasons why it didn't really pick it up. I think one of the fundamental reasons, we did try to improve for 10 years something on the bond market. It has done part job, which is improve the institutional clearing and settling, so back office side of it. They have done a good job on it. Some of the things which went on a back burner because it was more chicken and egg kind of demand versus, why provide that platform is kind of got announced today after the budget that the depository system of CDSL and NSDL can talk, but the depository system of CDSL, NSDL, and RBI could not talk. So that has been announced today. But the biggest challenge for the bond market development is, as Ashish said, that, why should I pay the intermediary spread? If the spread was positive spread, I can understand that you can remove that spread. But today the spread is actually a negative spread. What I'm trying to say is, I have of late, there are a lot of good things, bad things we can talk about, small things on the bond market. The biggest challenge, I think, is the 8, 9, 10 is the kind of indicative quote I've made myself. Around 8% historical average of government bond, 9% corporate bond, 10% nationalized bank deposit. It should have been other way around. But the reality is today the deposit rate is the highest rate which one is getting, and that is something we need to really, really address for the bond market to develop. And just getting drifted a little bit from the bond market, I also want to make a point that it's not only the bond market. We are very proud about the volumes and stuff on the equity side. But on the equity side, if you remove FIIs, which came in 96, what is the household holding of equities in this such a large market? So that's something we need to really think about it. And I think that is the biggest problem, even on that, for both bond and equity market, for people to really come in big way. The hurdle is the deposit rate, and something need to be done about it. So all I'm saying is PDMA is a right step towards bringing out independent debt management team, but we need to really have to sequence it in a right manner. We need to time it right. Maybe it might take a couple of years to do it, but timing and getting the other things right is very, very crucial. Thanks.
Thank you, sir. Before I introduce our next speaker, I'd like to quickly remind our audience that we will be having a question and answer session at the end of the talks. And so if you would like to ask a question, please write it down on the slips provided to you and pass these along to our representatives collecting them from the aisles. Let me now introduce our next speaker, Shri Ajay Shah. Currently a professor at the National Institute of Public Finance and Policy, Shri Ajay Shah studied at IIT Bombay and USC Los Angeles. He has held positions at the Center for Monitoring Indian Economy, Indira Gandhi Institute for Development Research, and the Ministry of Finance. He now leads the Macro Finance Group at National Institute of Public and Finance Policy in New Delhi. He does academic and policy-oriented research in the fields of Indian economic growth, open economy macroeconomics, public finance, financial economics, and pensions. I now invite Shri Ajay Shah to speak on moving towards global integration. Shri Ajay Shah.
Thank everybody for being in this very interesting meeting today. I just want to take 3 steps back from all the things that have been said, and I want to help put some context into what is going on. So all of you would have been aware of the discussions and debates and criticisms in Indian finance for a long time. And as Ashish and others have emphasized, a lot of this has come together in a single document, that is the Indian Financial Code drafted by FSLRC. Now the question is, how does this get implemented? And for some time, all of us were a little curious and skeptical that how is this going to be implemented. With the previous government in the UPA, the sense was that we don't have a majority in the Lok Sabha, we don't have a majority in the Rajya Sabha, and enacting a big complex legislation like this is going to be impossible. That changed after the elections of 2014, where suddenly it has become possible to do legislation in Lok Sabha and potentially in the Rajya Sabha as well. So the environment has changed considerably in terms of the possibilities. And the new government was keen on reopening some of these basic questions and trying to do a better job. So what seems to have happened in the budget speech and the finance bill is that some very important initiatives have come together. These are not the same as passing the Indian Financial Code, okay? But I think it is an important piece of progress which takes us closer to that goal. So let's think of some of the pieces. So the first big piece, which everybody has talked about, is this single market concept. The key intuition is that trading is trading. Whether you trade gold futures or you trade Nifty futures, there's really no difference. So no matter what be the financial product being traded, the machinery of the market system is really the same. And that gives natural economies of scale in terms of putting these things together. Now, does this mean that there will be no specialization? I think what is useful is to say that it is the choice of each firm how specialized it wants to be. So think like in the real economy. One firm might like to make cotton fabric. Another firm might like to make artificial fabric. It's their choice. Or if one firm wants to make both, it's their choice. If you think that there are economies of scale of the equipment, of you bring both together, it's your choice. The government is not saying that these two things have to be done separately. So I think that is the key point, that it should not be a government which says that bonds are different. It should be the choice of the financial firm. If Jayesh's firm decides that we will only do bonds and we don't have the skills, the talent, the franchise value, the competitive advantage to do equities, that is their call. If Dipti's firm says we want to do both equities and bonds and commodity futures and currencies, it is their call. So the point is, government should not be making this call. There are natural synergies in these markets. Now let people choose. So if one exchange wants to be a specialist, if Sameer's exchange says, I only want to do agricultural commodity futures, that is their choice. But if Sameer's exchange feels that I want to also trade Nifty futures, that should be their choice. It should not be the government which says that we will cut up this industry into separate verticals and forcibly keep each player inside a vertical. So I think that's the first big idea, that there is something deep inside all organized financial trading, which is the same. It is some trading system, it is some clearing, it is some mark to market, it is some margin, and it is some depository. So no matter how you look at it, there are economies of scale in doing all this work. Everybody in this room is doing the same work, but we've been cut up into different pieces. I have a bit of intuition here which may help think about this. I think of organized financial trading as three activities. Okay, the first is a housekeeping activity where you have all this computerized processing of trades. Okay, so in an ideal world, it's straight through processing, that my bank accounts, my depository accounts, the exchange, the securities firm, everything is wired together. So you put a trade and there is just processing work. Okay, so there's a very mundane processing work where the order flows, goes into some order matching system, gets matched, some margin gets paid, some depository settlement happens, some clearing money moves in and out of a bank account. So this is the most basic layer. Here it seems to me that the economies of scale are dramatic. This is the same. No matter what part of the market you operate in, this machinery is the same. Then the second level is what I think of as relatively mechanistic trading, which is now all algo. Okay, this is the arbitrage activities. So there's the garbage collection activity of finding mistakes in two prices and bringing the prices together. And this is entirely algorithmic in the modern world. And now once again, I want to say, if you pause to think about it, a spot futures arbitrage on gold is not that different from a spot futures arbitrage on a share. It's not that different from a covered interest parity arbitrage on the currency. So these are all, the formula changes, the basic work is the same. So yes, if I'm doing a covered interest parity arbitrage on the currency, it's a different formula that I will write into my program. If I'm doing a spot futures arbitrage on an equity share, it's a different formula I'll write on the program. But apart from that, it's actually all the same. So I think that when you pause to think about it, this is also something which will work horizontally. That inside the algo trading at BSE, you will get all these kind of strategies being rolled out. And then I think there are economies of scale, that the same firms will end up doing that kind of what I call garbage collection work, that there are mistakes in the market. Somebody needs to step in and make money by eliminating those mistakes. So all the formulaic pricing relationships are established. Then the third and the highest skill in the market is that of actually understanding the product, of actually having a view on what will happen to the price of gold, of actually understanding whether the share of Reliance is underpriced or overpriced, of actually having a view on whether the 10-year rate is going to go up or go down. Here, probably the economies of scale are more limited because it is incredibly hard understanding each market. So here there may be separate players. There is a natural role for a person who really understands wheat. And the person who truly understands wheat is probably different from the person who truly understands the exchange rate. And that's okay. So I'm not here to say that all parts of this market will be done by the same persons. So I'm here to say that let people choose. Maybe there is an intimate interconnection between gold and WIX trading. So then maybe the same person wants to trade WIX and gold, and in his mind these two come together. It should be the decision of the person. It should be the decision of the firm. It should be the decision of the private sector, how these things are organized. It should not be the decision of the government. So I'm just saying that the key insight is, let's get government out of it. Let the market system choose whether one particular fund finds it efficient to trade gold and Nifty together or not is the call of the people inside that organization. It should not be the call of the government. So the vision of unified securities trading is about saying that, look, there are some deep commonalities in these markets. Now let the private sector decide what is efficient. If somebody wants to start a firm which only does yield curve arbitrage, okay, please do so. Nobody prevents you from doing that. But if the guys doing yield curve arbitrage find that actually this is no different from doing covered interest parity arbitrage, okay, fine, you do that. Okay, so this is the idea number one, which is, can we bring all these markets together? And in the budget speech, 3 big pieces have been integrated. The erstwhile SEBI, which is equities and corporate bonds of more than 1 year maturity. Then the erstwhile FMC, which is the commodity futures. And the third is government securities. All these have been put together into one single unified market system. Just for clarity, there's a very confusing word called money market. I find it easier to not use that word. Okay, a government bond is a government bond is a government bond. If it has 1 day maturity or 1,000 years maturity, there's no difference. It's a security. It's got an ISIN. You trade it. There's nothing special about the word money market. So we should just focus on the word security. That if there is an ISIN, somebody is buying, somebody is selling, it's a security. So all government bonds come together and they join this main market. So I think that for everybody in this room, this is going to be an important and dramatic new period where we will need to choose business models. So every organization in this room will think, what business do you want to be in? And then it should be the decisions of the persons in this room that determines the structure of this market, not the central planning of some government which says that this market will be kept separate from this market. Okay, so this is the first big idea. The second big idea is PDMA. Everybody has already talked about it, that you need an investment banker for the government. And as Tarun emphasized, this is a subtle and sophisticated problem. It is not a mechanistic problem. I'm sure everybody in this room knows, at present in India, there is no single view of the entire activities of the government in borrowing and in contingent liabilities. The Ministry of Finance presently does the foreign side of it. The RBI does the domestic side of it. There is no database where these come together. So Tarun was saying it's an important call. Do you want to issue in dollars? Do you want to issue in yen? Do you want to issue in rupees? Well, I will say before you make that call, you need to bring the data together. That will happen for the first time in the construction of the PDMA. So we will get a new organization which will look at the full activities of the government bond market. And I think that this is a big and interesting and complex problem. India's GDP is roughly $2 trillion. The overall government debt is something like 65 or 70% of GDP. So this is an investment banker running a book of $1.4 trillion. It would be tantamount to being one of the biggest financial firms of the whole world in thinking about this balance sheet. And I think that they will be well incentivized in understanding how to make a deep and liquid government bond market because they would have to get the lowest cost of borrowing. The separation from RBI is important in 2 respects. First, because it is a conflict of interest for RBI to pursue inflation, which means sometimes raising rates, and to pursue the investment banking function, which means always trying to keep the rate low. They are different objectives. Another aspect of this is banking regulation. RBI, in his capacity as an investment banker, can make his job easy by increasing the SLR. So when the SLR is high, banks have no choice. Banks are forced to buy these government bonds. Then the job of the investment banker becomes easier. It's good to separate these things out, that the banking regulator should think about how to make banks safe and sound. The investment banker should think, how am I going to sell these bonds and to who? If you put these things together, it generates bad outcomes. The third big change is clarification of the role of RBI. All these years, we've had an RBI Act which was set up in 1934, which was really not clear about what RBI is all about. And I'm sure all of you know it is very amusing. Right in the preamble of the RBI Act, our colonial masters say, and this is, I'm quoting from the preamble of the RBI Act, it says that in the present state of disorganization of the international monetary system, it is not possible to determine what is an appropriate monetary policy arrangement for India. Hence, as a temporary measure, we create the Reserve Bank of India. This is right up there in the first para of the RBI Act. And that was done in 1934. The world is different in 2015. We understand a lot more about how these things are done, and it is time to start setting up a sound institution. So I think there are serious problems. There are birth defects in this organization, which have given us all the problems that we have seen. So our difficulties with RBI are not a reflection on the individuals. It is really an impossible job to try to be all these things and do so many different things. So now for the first time, RBI has an objective. It has an inflation target. It has to deliver CPI inflation between 2% and 6%. Okay? What has inflation been in India in the last 15 years? It has been between 2% and 16%. Okay, so that is a failure of printing money in India, that we've got inflation between 2% and 16%. Now RBI will have a clear mandate. He has to deliver between 2% and 6%. And this is accountability. All of us will be able to look at CPI data and know whether RBI is delivering on this or not. So that is a very healthy arrangement where we create accountable government agencies who are mandated to do a job and are held accountable for doing that job. Along with that, many extraneous functions have to go out. It doesn't make sense for a central bank to do investment banking for the government. It doesn't make sense for a central bank to run regulation of the government bond market. It doesn't make sense for a central bank to run an exchange where bonds are traded. It doesn't make sense for a central bank to run a depository where government bonds are stored. It doesn't make sense for a central bank to do regulation of capital controls, and so on. I could go on and on. So there are all sorts of unlikely functions which have been thrown together, and it is important to now rationalize these things to put this work at the right place and achieve clarity and accountability. Now, for all of us with a private sector background, we know that corporate restructurings happen all the time. Right? This is no big deal. It's a part of life. It is painful. Now, in many a corporate restructuring, the stakes are actually high in the sense that some people lose their jobs. Right? So corporate restructuring can be politically dangerous because some people are going to lose their jobs. In government, corporate restructuring actually has very low consequences because nobody ever loses his job. Okay, so what is going on is just some corporate restructuring. There's some civil servant who's doing some work. He moves to another banner. He carries a different visiting card. Nobody loses their jobs. So I don't see what is there to get excited about. So when we do corporate restructuring, we all work for the people of India. We all work for the government. There's no need to get tempers up. So I think that these are important changes, and they will add value, and there is nothing to get excited about. I don't understand why there is so much angst on these trivial little matters of whether I work for RBI or whether I work for PDMA. These are minor details. What is important is to be clear on objectives, is to be professional, is to construct high-quality organizations, and do a good job. Tarun correctly emphasized that this is technically complex. So we've never done public debt management in India in any kind of serious sense. As I said, we don't even have the data in one place, leave alone thinking about it in more sophisticated ways. Government has set up many new institutions in the past. We are all witness of the creation of SEBI, the creation of PFRDA, the creation of IRDA, and so on. There is a new development in the last 2-3 years, which is that there is a whole new professionalism and a new kind of machinery through which government is now creating new institutions. Okay, so how did government create SEBI? They hired some amazing people called Surendra Dave and Ravi Narayan and Nagesh, is he here? GV Nageshwar Rao and so on, and they said, hey guys, please start SEBI. Okay, and those guys sort of rented an office and started trying to build SEBI. Ashish talked about being part of the founding team of NSE. It was similar. Some 5 guys were hired and told, hey, go start NSE. Things are becoming a little better. They're becoming more professional now. What Ministry of Finance has started doing is that for setting up a new institution, they're setting up a task force. The task force is doing a project plan. It is more like building a bridge rather than just a bunch of 5 guys starting to do something. So there is a Gantt chart. There is a clear set of all the work products that are going to lead up to the institution. There is a sensible view that an institution is a set of processes and IT systems. So you need a set of process manuals and you need a set of IT systems. So these spec documents are being written through consulting and IT companies. And a whole set of these formal documents, processes, and IT systems are being put together through which these institutions come to life. So instead of bringing in 5 guys and telling them to start an institution, it's being done in a much more professional way. Now again, these things have always been done for hardware projects by the government in the past. When the government built Bandra Worli Sea Link, it did not hire 5 people and tell them go build a bridge. There is a formal project management about how you build a bridge. Now those kind of formal methods are being brought into constructing the soft infrastructure of the country, namely organizations like the PDMA. So the task force for constructing the PDMA got going in September last year, and by the time of this budget speech, there was enough confidence that a good deal of work has been done, and we have a sense of the lay of the land, and that gave confidence to go through with the next set of measures. As you can see, all these things are tightly interconnected. If you don't have a properly functioning bond market, the PDMA's job is difficult. If you don't have a properly functioning bond market, the inflation targeting is difficult, because when RBI changes the rate, as we know with banking in India, not much changes. So the real monetary policy transmission will work through the bond market, and it is absolutely essential to have a proper bond market with yield curve arbitrage so that the inflation targeting will actually happen. If the PDMA is not taken out of RBI, then RBI remains conflicted because he has an incentive to keep interest rates low and so on. So these things are all complicated and interconnected, and part of why many of these changes did not get done in the past is because if you look at any one of them in isolation, it looks too difficult. It seems that the rest of the machinery is not there. What is interesting and important and remarkable about the thought process at the Ministry of Finance in early 2015 was this sense that if we do the whole thing together, it's actually easier, and the whole thing is going to work much better. So, as Ashish said, we had a really exciting time with financial reforms in the early 90s, and it led up to 2001, where we got the equity derivatives going. And for a long time, there's been quite some stagnation in Indian finance. We've just not made progress. And I'm really excited about what these changes and announcements now imply. And for everybody in this room, life is going to change in important ways. And we are back to the process of thinking what would an appropriate strategy for each of us be in this new world.
Thank you, sir. Thank you to all our esteemed speakers for sharing their perspectives today. We will now have a question and answer session with our speakers. If you have a question, please pass along your question slip to our representatives collecting them from the aisles if you have not already done so. I've already been handed some questions. Some of them are going to be directed to specific speakers, but others are open to the panel, so whoever would like to answer them can please share their ideas on the answers. Some people have specified who they are asking the question, others have been asked anonymously. So to start with, FMC merged into SEBI will regulate commodity derivatives but not trading in commodities. How to counter for twin regulation problem for a single commodity? How will SEBI guarantee delivery of commodities to buyers, overcoming the inflation? Any pressures due to cash settlement only? Quite a long question. Should I repeat the question? Okay, I think it has two parts, so why don't we address the first part first. FMC merged into SEBI will regulate commodity derivatives but not trading in commodities. How to counter for twin regulation problem for a single commodity?
So I'll take a first stab at it, and if any of you have anything to add, feel free. I'm not sure I understand the full question, but I'll just yeah. So I think I'll take the second question, which is how will SEBI guarantee delivery of commodities to buyers, overcoming the inflationary pressures due to cash settlement only? I think this is, it's an interesting, very interesting question. But in my view, a perception is perhaps slightly different, but in my view, it's a problem that's already been solved by FMC through creating fairly credible delivery infrastructure through warehouses. And of course, there is room to develop, and WTRA needs to get involved and give more credibility to the warehousing sector. So there's always most initiatives have a long way to go in terms of becoming efficient and effective. But conceptually the problem is solved. I don't see any reason why SEBI would look at that problem in a different way. I think SEBI will only bring more credibility, more autonomy into that entire process. So I don't see that as being a major challenge. I think it's just a question of creating scale, creating better market, more market participants, more sophisticated price risk bearers, and bringing them into the institution. So it's not really a problem that needs to be seriously worried about. Is my view. The first question, I'm not really that sure if I understand the question, so I'll give it a pass. Anyone like that?
I'm going to proceed with the next question. What should be the role of the banking or financial institutions in aiding the next wave of financial sector reforms? This question is for Ashish Kumar Chauhan, and it comes from Shulin Satoskar. I'll repeat the question. What should be the role of the banking or financial institutions in aiding the next wave of financial sector reforms?
I think there is a perception that all these things are different. The banking system is completely different and the markets are completely different. They are part of the same continuum. So effectively, if you want to invest money and you want to invest money in, say, risk-free activities, where will you go and invest? Today, banks are practically risk-free because buyers don't have to beware. It's, in a sense, government guaranteed. And so, effectively, if you want to be risk-free, you go to banks. And then if you want to go into little higher risk models, then you go into equities or hybrids and so on and so forth. So that is how, these all fully sort of connected with each other, whether we see them at different or not. And it was, in a sense, like my childhood, when I was young, I used to think that a grocery store is different from a furniture store and is different from a bookstore. When I grew up, suddenly I found that in US, when I visited US, everything was in one single sort of store. And then I realized that these are all basically things which people sell, somebody else manufactures, and you are only selling at that front end, and somehow we were made to think they are all different things, and that's why we had different regulators. A pension or an insurance, how different they are. They look very different if you think that way, but they look very same if you think the other way. So effectively, this is all one single continuum, and reforms is about basically how do we use the financial system to help the country reduce inflation, get jobs, and reduce corruption, right? And so, if you have heard of Prime Minister's Jan Dhan scheme, they've got around 15 crore new bank accounts opened for people. Now that is not to, when opening a bank account is one part, but then putting subsidies there, putting everything else through that activity is going to be phenomenally different and reduce the corruption overall. So for me, if you look at it as a one single continuum, then the question of whether banking system will help or the markets as the way we know will help or something else will help, it actually goes away, because all of them are one single sort of way to look at things, but probably academics will have a little more light on what I said.
Here's a question for Ajay Bhai and Samir Bhai. Agri-commodity prices are impacted by God and the government on supply and demand fundamentals of price determination. The convergence of financial market impacts with investment angle. Therefore, how do you view price discovery in integrated markets? Distortions by hedge funds are well known. Should I repeat that? You got it?
So I think the way we should think about this is that there is a price discovery question. what will the price of wheat be in December 2015? That is what we are all speculating on. Nobody knows. Nobody knows the truth. But today we have to stand and speculate. And the futures market discovers that price, and then based on that futures price, people can make storage decisions, people can make sowing decisions. That's the job of the market, to discover the price that guides the working of the real economy. Now, it is our claim here that the unification and integration of these markets will reduce costs, will improve the working of the regulation, and thereby will do the price discovery better.
By the way, hedge funds are good if you know how to regulate them. Hedge funds are not such a bad word after all, because the stories that we tell about cross-market arbitrage, making markets efficient, somebody got to do it. And the problem that comes is if you don't have good risk management system, integrating policy, then certain institutions will obviously take advantage of it. We know it in our school days, right? If the principal is not strict, there will be misbehaved students. So I don't think hedge funds is such a bad thing for price discovery.
Would you like to share some here?
You want to ask a question, sir? Give it to you. Thank you.
So the purpose of asking the question is, your point is well taken that the hedge funds create the inter-agri markets competence or tries to bring a kind of an equilibrium. But the point is that the hedge markets work with very large muscle power and resources. So my question is, does it not? Because the discussion was, Ajay Bhai said, that we are concerned with the implementative part. Now, two aspects of any kind of future management is, one is the risk management, very well done by integration, but the question is the price discovery, and because the very nature, the hedge funds are only interested in investment, whereas the commodities are functional for the consumption goods, that is for the industry. So there is a cleavage of difference. So whether, does it not affect a kind of a price discovery system? But if so, I don't say the convergence is bad, but I say how we correct it. I am talking only from the point of view of correction. And that's why my question is addressed to both. How do we make the price discovery system perfect in the new system? That is my question.
With incredible prescience, we have one of the world's top authorities on hedge funds right here with us.
Thank you, but that's, your question is very appropriate. I have a paper on this particular topic with Viral Acharya and another co-author of ours at Columbia. The question that you're asking is very appropriate, because if you think about a commodities market, there are two broadly defined groups of people who participate in those markets. There are natural hedgers, who are those who are participating in the market because of the fact that they have real obligations on one side that they wish to hedge. And then there are people who create the space for them to hedge, which are the speculators. And so this is basically Keynes' old theory of hedging pressure affecting commodity prices. Now what Keynes said back in the day, and which we now have data to verify, which is true, is that dislocations on either side, either an increase in risk aversion on the part of hedgers, or an increase in capital supply or capital demand on the part of the speculators, can actually affect dislocations and cause dislocations in the commodities prices. This can actually affect spot prices as well. You're absolutely right about this. Now, of course, it is at this point the job of a regulator to step in and say, look, we're suffering an aggregate liquidity crisis. This is one of the reasons why, for example, you see prices rising. And that prices rising are not necessarily a signal of the fact that the actual price of the commodity is likely to rise because of any fundamental reasons, but it's because of the fact that there are some capital shortages that are causing these issues in the futures market. Now, it's absolutely, that is the case. Now, my general solution to all of these problems is one that generally delights regulators. I think we should pay regulators much more than we do right now. I think the big problem is that we haven't developed regulatory capacity to the point at which people can make these kinds of determinations in the current environment. And I suspect that what we need to do is to increase the technical capability of the regulators so that they're able to perceive these kinds of situations.
Another question for the panel. How will individual investors get access to the government bonds?
If Ashish so chooses, exactly as individual investors get access to equities.
In fact, last year we had given a proposal to RBI saying primary auctions of government bonds should be done through the exchange mechanism, like what we do in offer for sale. Tomorrow there is one REC offer for sale. Some of you might like to participate. But effectively, like the way we do it in equities and other OFS and other areas, same way, same mechanism can be used for auctioning government bonds also. And in that, even large banks can participate, primary dealers can participate it, and many more can participate. So effectively, instead of having a small group, what I call walled garden approach, which is currently there, if you open the garden, many more people will come and loiter, and who knows, they will also participate. So that is basically the framework for selling the government bonds. But more importantly, how do we bring them again and again? That is when we give them liquidity. Once a person invests, he also wants to exit at some point. In bond situation, exit happens finally at the expiry. But in case somebody wants to come out in the middle, and if you are able to give them sufficient liquidity, then more and more people will actually come and invest in the market. So we need to worry about the primary market, as we call it, initial issuance, and then secondary market, that is basically ability to come out. And then there is what I call tertiary market, although it is not known as tertiary market in the literature, is the derivatives market, which is over and above the secondary market. And so if you are able to give all three in some conjunction, then we have basically an end-to-end market.
Thank you. 3 questions. How technology friendly is the commodities market? What reforms are essential in commodities market in order to achieve efficiencies? And then there's a third question about currency market, which I'll get to after we address these commodity market related questions.
So I think the commodity markets are structured very similar to capital markets, and the convergence has been happening progressively over the last 10 years. So from a technology perspective, I think they are right up there, comparable with the capital markets. There are micro regulations also which have sort of about the microstructure of the market that have started to converge with the capital markets over the last 24 months. FMC has tried to sort of bring things in line with SEBI directives and capital market guidelines. So I think we are almost there. Of course, there are structural inefficiencies in commodity markets because certain products are not permitted and certain participants are not permitted. But none of them are technology restrictions or sort of microstructure restrictions. They're really restrictions of product types and participant types. And with the SEBI FMC merger, those two fundamental questions get addressed, that the exclusion of certain products or the exclusion of certain participants will go away and the markets will become more like each other. But I don't think that there are any technology lack of capabilities from a technology perspective for these markets. They run very similar to the way capital markets run.
Let me give you some more understanding. What we do in exchanges is what I call transaction processing. We allow agreement to exchange, that is called trade. Then we do clearing and clearing part, that is deciding on obligations, and then we allow settlement. So when it's a spot market, it happens within 2 days. If it's a futures or options market, it happens over 2-3 months or whatever year, and so for which we do risk management and stuff like that. But it's a very simple, what I call transaction processing management framework. in say 300 years back, 400 years back, when exchanges came up, they came up only for goods which could be easily standardized. The securities could be easily standardized because they were in certificate form, so they could be easily handled. Even commodities like wheat, rice and all were easily standardized, so they could be done. But over a period, the e-commerce has come to a level that even a single piece, which is completely non-standardized, can be also traded through a framework which is a large market using computer networks. So 2 weeks back, I read a news item that Snapdeal or somebody is actually having stocks being traded there on spot. I don't remember exactly whether it was Snapdeal or something else, but people have started trading whether we like it or not. So effectively, again, there is a continuum of transaction processing where even if the exchanges and their regulators start looking as if they are very different and not comparable, the rest of the world doesn't think so and they will start trading outside. So we have a choice to actually start becoming little more understanding of the changes that are happening technologically and how actually we do it so that additional scams don't come up outside, because the formal finance has not reached the nooks and corners of India. We have allowed all the Shraddha scam and all sorts of scams because the banks have not reached, insurance companies have not reached, exchanges have not reached, mutual funds have not reached because of the cost and other reasons. But that has actually kept a lot of things open. And this is very, very highly regulated market because the securities and even commodities are in some sense very sensitive and very important. So governments try to regulate. But if we don't reach out in an easy to use way to the masses, you will have several more scams happening outside of this framework, which may have some repercussions, some fallout on this market. One of them, you heard Samir's speech about a market which was not regulated by FMC, but ended up creating issue.
So you had a question?
I actually have a question on this conflict of interest issue. At a top level, both Reserve Bank of India and any other public debt management agency, they are the agents of the government. Now, public debt management, getting low cost of borrowing for the government and controlling inflation. At the government level, the conflict of objective still continues. Because if you take out from RBI, the public debt management, it is left with inflation targeting. PDMA has the responsibility at the level of minimizing the cost of borrowing for public debt. And so if a government follows a conflicting policy of pumping money or high fiscal deficits and gives an inflation target, the conflict of objective is still there at the government level. How does reorganization solve the problem?
The central bank is accountable for the inflation target if there are expansionary conditions in the economy with large deficits, then the central bank will raise rates.
Yeah, I mean, this was one of the points that I tried to raise in my discussion, which was that that's right. I mean, if there's an adverse selection on monetary policy at the RBI end of things, there's equally an adverse selection on fiscal policy at the government end of things. Doesn't seem to me that those two issues are particularly different, reputationally speaking. But,
No, I think it's different in an important way. I think it is very healthy and good for the country if mismanagement of fiscal policy elicits an interest rate reaction by the central bank. It changes the behavior of the Ministry of Finance. If a central bank will accommodate, then the Ministry of Finance is going to be more irresponsible, not less. So if the Ministry of Finance will run a 8% fiscal deficit, the job of the PDMA is, I will hunt all over the world and I will find the cheapest possible financing. But we know that that is an expansionary fiscal policy. It is likely to trigger off inflationary expectations. It will show up in the tips like markets. And the central bank should respond to that saying, hey, my mandate is to keep inflation 2 to 6. And if I see fiscal policy is not performing, doing the right things, I will raise rates. Raising the rates will make the interest burden, the interest cost of the government higher. And this will generate more sensible behavior on the part of the fiscal authority. So I think this separation is key. It actually produces a better outcome. And this is part of why all over the world we get this separation.
to your point, the history of the two institutions is that there used to be automatic monetization of the deficit at some point. And so what you're saying effectively is that that has gone away, but not completely. And in some sense, what you want is for that to go away completely by taking away all fiscal responsibilities from the monetary authority. Fair enough.
It would actually be nice if you talk a little bit about how market participants could deal if the separation will make central bank more credible.
I think market participant, for them, it's the most important thing is in a undeveloped bond market. See, and there is a reason for the bond market not being developed. It's not that somebody didn't do enough for it, but there is a structural issue today. That's the reason we don't have a developed bond market. There is also another thing is also, unlike equities, FIIs are fully not allowed into the bond market. So that's also a different situation. But in absence of that, I think the biggest comfort the market today has is the stability on the bond market. So if you look at what has happened on the interest rate, on the inflation, on fiscal, I think there is stability on the government bond side, and whether it's managed or whatever way it is, but there is stability. It's not so volatile. It's not really moving with the CPI inflation or anything else from 6 to 14%. And that could happen if this is not coordinated well. And of course, as I said, that will push government to borrow less, but then that volatility to the financial system, it can actually create damage, a lot of damage to the financial system if that volatility is there. So I think today the world has moved to mark-to-market, and in that mark-to-market situation, if you had bought something at say 6-8% and suddenly it goes to 14%, and today let's not forget these bonds are mostly held by insurance and banks, which is the financial sector main pillar, right? And if they're on their mark-to-market, if they have 400 basis point move on their portfolio, I think that's going to be a big challenge.
We have time for 2 more questions, so unfortunately we won't get to ask all the questions that we received. But so for the final 2 questions, the first one is directed to Mr. Ajay Shah, and it's from Deepthi Neelkantan. How robust and stable is the Government of India's statistical organization for calculation of CPI, WPI, etc.? When an institution's performance is measured versus such numbers, it will have to be a very responsible activity to calculate indexes.
So a couple of years ago, when at NIPFP, when we started understanding this full picture of how fiscal, financial, and monetary policy was going to work, we got worried about exactly this question, that this whole framework falls apart if you can't trust the CPI, okay? Because the CPI is the foundation of the monetary policy. So we went and wrote a paper where we did 2 things. Step 1, we took independent private sector household surveys and cross-checked the weightages of the various commodities of onions and potatoes and so on when compared with the government CPI. And step 2, we took the spot prices that are being produced by Samir Shah and by CMI, and we used them to cross-check the prices of the individual subcomponents inside the CPI. Okay, so check the weights, check the numbers, and we thought that if you do these 2 checks, then it was a good way of assessing the quality of the CPI. And by and large, we thought that what was going on was reasonably good. So we did not find important discrepancies in the calculations. So a private source of price data was corroborating with the government, and a private source of the consumer consumption basket was corroborating with the government's data. Then after that, the government moved from CPI to CPI new. Then we went back and we evaluated the work that was done in the CPI new. This has come out on my blog, and here also we thought that this is a pretty decent job. So overall, we are reasonably happy at the measurement of CPI.
It turns out we actually don't have any more time for questions, so my apologies, we won't be able to take that last question. Thank you all for your answers. I now request Shri Ashish Kumar Chauhan, MD and CEO of BSE, to present mementos to our esteemed guests. Shri Tarun Ramadurai, Professor of Financial Economics, Said Business School, University of Oxford. Shri Jayesh Mehta, Managing Director and Treasurer, Bank of America. Dr. Gangadhar Darbha, Executive Director and Head, Algorithmic Trading Strategies at Nomura. Shri Samir Shah, MD and CEO, NCTEX. Shri Ajay Shah, Professor, National Institute of Public Finance and Policy. And Shri Prabodh Thakkar, President, Indian Merchants Chamber. Oh, he's left, sorry. All right. I now request Shri Ashish Kumar Chauhan to give the closing remarks.
I'll take probably 1 or 2 minutes. It has been an exhilarating discussion. I learned a lot, and I hope all of you learned a lot. The audience, the numbers, even in the evening, late evening, suggest that it was a great discussion. So thank you very much to all the panelists, to everyone who came, and also to the media for coming in large numbers. Thank you very much.